Mid-sized companies continue to lead the U.S. economy in both revenue growth and job creation. That said, for the last 6 months, we've seen a leveling off in the rate at which both revenues and jobs have increased. I'm Tom Stewart, the Executive Director of the National Center for the Middle Market at the Fisher College of Business at The Ohio State University, and I'm here to present the results of our Middle Market Indicator for the second quarter of 2015. The Middle Market Indicator, the MMI, is a pulse check of the companies that comprise the middle third of the U.S. economy. Those are companies with revenues between $10 million and $1 billion a year. About a third of jobs and about a third of GDP is created by those companies in the middle. About a third is created by companies that are smaller, and another third is created by companies that are larger. Every quarter, we survey 1,000 of these mid-sized companies to take their pulse. We ask them about their top line, we ask them about their profitability, we ask them about job creation, we ask them about their plans, their confidence, their investment appetite, and the challenges that we face. So what did we learn? These data were collected in the second half of June 2015. As usual, let's start with the top line, with revenue. Year on year, the average revenue growth for companies in the middle market was 6.6%. That's exactly the same percent as we saw in the second quarter of 2014. It is, however, lower than the revenue growth we saw in the 3 quarters in between, when revenue growth was 7.2, 7.4, 7.5%. So it has shrunk. The rate of growth has shrunk. Should we be concerned about that number? No, for a number of reasons. First of all, the number is very strong. To give you some perspective, 6.6% growth is less than half a percentage point lower than the growth of the economy of China. Second of all, at this stage in a recovery, and this recovery is 6 years old, which makes it a senior citizen as far as recoveries go. At this stage in a recovery, you expect to see a flattening out in the rate of growth. Third, it's clear that middle market companies are continuing to play their role as the growth engine of the economy. The middle market has always outperformed in terms of revenue the big companies in the S&P 500, but the gap this quarter was nearly 8 percentage points, the highest we've ever seen. Indeed, the S&P 500 top line actually shrank 1.77% in the second quarter. Now, a number of factors can explain this for the S&P 500. First of all, that index includes a number of companies in industries that really took it on the chin. Energy was one of them, materials was another. Those are less represented in the middle market. Second of all, a strong dollar has created more headwinds for large companies because it's an inhibitor of exports, whereas the strong US dollar has actually been a boon to the middle market. Most US middle market companies sell exclusively in the United States, and a strong dollar has actually lowered the cost of imported raw materials for them. So those are a couple of reasons why the middle market has substantially outperformed the S&P 500 and continued in its role as the growth engine of the economy. That's growth. What about confidence? Looking ahead, executives in the middle market are confident, but their outlook is a little less rosy than we saw it was a quarter ago. We see this first of all in their expression of confidence in the local and national economies, both of which have dipped from the first quarter. Now, they've only dipped to the level that we saw, the high level that we saw in the fourth quarter of 2014, but it's a bit of an expression of wariness. And we see that wariness showing up in a number of ways in the middle market. We see it showing up in hiring plans, we see it showing up in investment plans, we see it showing up in growth projections. Looking ahead, middle market executives find 3 things that may be tamping down their confidence. First is fear that as unemployment drops, and at least one governor of the Federal Reserve has said we're nearing full employment, as unemployment drops, they fear that wages may increase, labor costs may increase. Of course, employees fear or hope that their wages may increase. Second, there's some concern that the cost of energy may have bottomed out and may be on its way back up. And third, there is concern that the Fed might get around to raising interest rates at some point in the third or fourth quarter of this year. Taken together, these 3 things have middle market executives projecting an increase in their profit margins of 2.4%, which is down from 3.1%, which they told us last quarter. Still a strong increase, but less strong than what they anticipated and reflective of that little bit of tamping down of confidence. Strong on the top line, but slightly more cautious. Confident, but slightly less bullish. Profitable, but a little more anxious about costs. What is the middle market doing? Well, let's start with employment. Employment growth in the middle market continues to be strong, but again, the rate of increase has gone down from what we saw in the 3 previous quarters. That year-on-year job growth is 3.9%. That is a higher number than in the comparable quarter a year ago when it was 3.2%, but it is lower than the 5% and the 4.7% numbers that we saw in between. So the middle market is holding the line a little bit on its hiring. How and why is that happening? First, at this stage in a recovery, as I mentioned before about growth, you'd expect to see a slowing growth rate. Second of all, middle market companies that have open positions are finding it harder to fill them as the unemployment ranks drop. Talent issues, the ability to find, woo, and retain talent, have risen to the #1 challenge that middle market companies face. So that, the difficulty finding talent, has to some extent slowed hiring. And third, middle market companies are holding back. Innately cautious, they don't want to get out over their skis, and they want to make sure that they don't undertake hiring obligations until they actually need them. Most middle market companies, the vast majority, say that their workforce is just about the right size. But a similar vast majority says it expects to be hiring within the next 12 months. The job story has a parallel on the investment side of the ledger. Investments, almost by definition, can't be done just in time. And so we continue to see a robust appetite for investment with middle market companies. Asked if you had an extra dollar, would you invest it or save it? 67% say that they would invest it. That's a strong number, and we've seen the same strong number now for 3 quarters in a row. We also are seeing mixed messages overall about investment. On the one hand, you see about a quarter of middle market companies, more than a quarter, saying that they expect to make an acquisition in the next 12 months. On the other hand, you see about 20%, which is a slightly lower number than we've seen before, that say they're likely to open a new plant or facility in the next 12 months. On the bullish side, R&D budgets are unchanged and still pretty high. On the slightly more cautious side, 40% of middle market companies say they expect to introduce a new product or service in the coming year, and 45% actually did in the last year. So you see a mixed signal in both investment and employment, where you see an appetite for growth being held back by a desire not to get out too far in front of things. Let me add it up. Both growth and profitability were very strong in the second quarter. Both, however, were tamped down a little bit from what we saw in the quarter before. A similar picture shows up with jobs. Strong job growth, but a little less strong than we saw. Second, projections are more cautious than what we have seen before. Again, they're robust, but they are not as aggressive as the projections that we saw in the first quarter and in the fourth quarter of last year, which were extremely strong. Due to anxiety, perhaps, about labor costs, energy costs, and other costs, we're seeing the middle market be a little bit more cautious than it was before. And third, the middle market continues to play its role as the part of the U.S. economy that delivers the highest top-line growth and the highest job growth. There's much more behind the middle market indicator, and I urge you to go to our website, middlemarketcenter.org, where all of the data for the full middle market indicator report are there. So are all the data, the raw data files for this report, and all of the middle market indicators for the 13 previous quarters at which we've been tracking the progress and importance of the United States middle market. Thank you very much.